I'm Jenny Brown and welcome to this week's Buy to Let Market Update. I hope everybody is keeping really well. Look, you know what, the weather's starting to improve, things are looking up. It's a real shame about the foot, but I'm sure we're all incredibly disappointed. The good news is there's lots of positive stuff to talk to you about this week in terms of changes from our lenders. So lots of movement there, which I'm going to run through with you. We're also going to talk a bit more about what the housing market is up to since the first sort of wave of stamp duty holiday ending. And we're also going to update you on the building safety bill, which was announced last week. So lots of really good things to cover off with you this time. So first up this week, we have seen Foundation Home Loans continue with the absolute assault they are making on their product offering and criteria. They're making changes on a really regular basis and all for the better, I hasten to add. So first of all, what they have done is release a new limited edition product for portfolio landlords. So this is for those landlords with 4 or more properties in the background. Now this product means that pricing for portfolio landlords now starts from 2.99% for a 5-year fix at 75% loan to value. Now the product that they've released has a free valuation, there's no application fee. It's available for both purchases and remortgages. It's available to limited companies and individuals. The maximum loan amount on this particular product is £750,000. The minimum loan amount is just £50,000. Now, in terms of Foundation Home Loans and who they're willing to lend to, their criteria is incredibly landlord friendly. So, no minimum income requirement, a very favourable approach to the background portfolio. They made some changes to this, which we talked about last week, but I would say it's one of the most generous on the market at the moment. They do allow day one remortgages. They can accept layered limited companies. You can be age 80 at the point of application, and they're only taking personal guarantees from the directors of the company, so they're not underwriting the shareholders. Now, this is particularly advantageous for those people whose limited companies have, for example, shareholders who are children or other people who simply do not want to be part of the application process. So they're just going to underwrite the directors, which is very good. So as well as bringing out this really wonderful limited edition product, and I should hasten to add here, when we say limited edition, what this means is that the lender has said we have X amount of money, a limited tranche of funds to lend at this rate. And when that tranche of funds is used up, it's gone, there's no more. They don't tell us the amount of money that they have available to lend at a particular rate. So it really is a case of, if this rate is of interest to you, give us a shout, and we'll need to apply for it quickly because, like I say, once the money has gone, it's gone and there's no more. Now, there's been some further changes from Foundation Home Loans in terms of their offering, which are also really good. So the first thing is that they are now introducing a pre-underwritten facility and for landlords who are looking to add to their portfolio within 6 months. So what that means is, if you apply for a mortgage with them today and you're thinking about buying a property, adding to your portfolio within the next 6 months, they will pre-underwrite that application for the onward purchase at the same time, which means that when you come back to them with that new property purchase ready to go, your application will be streamlined. It will slide straight through because the underwriting has already been done for you, which means that you're going to be able to move forward incredibly quickly, and also it's going to save you just the kind of aggravation of providing you documentation and so on. So really fantastic there from Foundation Home Loans, very pioneering, which we obviously will always applaud. Now, the last thing that they've done is increase their maximum loan to value on HMOs and multi-units. So they're now able to lend on these at 80%. And again, that's for limited companies and individuals on purchases and remortgages. Pricing starts from 4.39%. And there are flat arrangement fees on these products. So they're actually not bad at all given the higher LTV space which they're operating within. So with Foundation Home Loans, they can accept HMOs of up to 6 rooms and multi-units of up to 10 self-contained units. And the approach to underwriting, which I've just mentioned, applies also on these products as well. So a really great series of changes from Foundation Home Loans over the last week. Okay, so a change from Lambay, which I'm really pleased about. They have now introduced HMO mortgages for first-time landlords. So what they're doing is they're saying that they're able to lend to first-time landlords on small HMOs, those with up to 6 rooms. The rates are not bad at all. They're starting from 3.49%. And you can borrow via a limited company or personal names as well. Now, the reason this is important and the reason this pleases me is that there is a real gap in the market for lenders who are happy to lend on HMOs to first-time landlords. Most of the lenders who offer HMO and multi-unit mortgages do want their borrower to have experience of renting out property. The reason for this is that if you have never been a landlord before, you take on a 6-bedroom HMO, then suddenly you're not managing kind of one set of tenants, you're managing 6. Those HMO landlords will know, who are watching this will know and agree that actually the requirements when you're running an HMO are quite onerous in terms of licensing requirements, various kind of things that need to sit within the property in terms of safety, which are obviously very, very important. And lenders kind of take the position that actually it's probably best to cut your teeth in a more standard buy-to-let property before you delve into the slightly more complex and involved world of HMO landlording, as it were. But look, there are a couple of other lenders who will do HMOs for first-time landlords. Landbay are by no means the first lender to pioneer this, but actually because it is just a couple of lenders who have this offering, it's really great to see Landbay come into the market in that space, offering, it's a fairly conservative loan to value at 70%. We can get higher for first-time landlords and HMOs, but what I would say is I think their pricing is really good in that space. So well done, Landbay, for coming into that market. Fleet Mortgages have now entered the 80% loan to value lending space, so great news there. And I think really, as well as it been just a really positive addition to have another lender come into 80% lending, what this really tells us is where lenders' views are on the property market. So as lenders start to push up loan to value lending, that really just kind of indicates a confidence in terms of house prices really kind of being quite solid. They're not expecting things to come down. So a great indication of where we are there. So their 80% products are starting from 3.89%. Are they market leading? No, but they are still competitively priced, especially when we take into consideration the fact that they're able to lend to limited companies as well as individuals. They've also brought their rates down across their entire range, so their pricing now starts at lower loan to values from 2.99%. Now look, Fleet is a lender that I think they go fairly under the radar. They're not a large shouty lender who are constantly kind of strong with their marketing, but actually I really, really do rate Fleet Mortgages. I think their offering is incredibly solid. They're a great lender to deal with. So look, here are some USPs from their lending criteria. So first of all, you can be aged up to 89 at the point of application. They need you to have income of £25,000 a year if you're a first-time landlord, £15,000 per year if you are an experienced landlord. They don't mind how many properties you have in the background. In terms of property types, now they can consider HMOs and multi-units. They're very generous with these. They can definitely consider the larger, particularly blocks of flats. They're also very, very good at properties which some lenders may decline. So, for example, deck access flats, ex-local authority flats, high-rises, things over commercial, they're actually very strong at as well, particularly those types of commercial which a lot of lenders will back away from. So, for example, things that are open late, any kinds of restaurants or food outlets, that kind of thing. So, really, really good offering. They can also consider day one remortgages, and they do also have some products with no early repayment charges as well. So a great offering from Fleet Mortgages, and great to see them moving into the 80% loan to value space. Like I say, it's a really, really good indicator of where lenders are expecting property prices to go in the future. Kent Reliance have also made some reductions to their pricing in the last week. Their rates now start from 2.99%. I honestly cannot remember Kent Reliance rates ever being quite so low, which is again a really indicator of where the market is at the moment. Now, Kent Reliance are another lender who I genuinely really, really like dealing with. I think we're quite lucky as a brokerage. We have a really strong relationship with them. So, we enjoy great service from them as a lender, and we find them to be incredibly flexible on their lending criteria and their approach to underwriting. So, like I say, rates starting from a really good 2.99%, available to limited companies and individuals. They're happy to take on people with really large portfolios in the background. Minimum property value for Kent Reliance is £75,000. They can consider day one remortgages. They're very good at these actually, so you don't even really need to demonstrate that you've added any value to the property if you want to lend against open market value. So what I mean by that is, say you went out and bought a property today for £100,000, but actually you just, by some streak of luck, were able to negotiate a really, really good deal. And actually the true market value of the property was 150,000. Kent Reliance are quite happy to accept simply that the property value is £150,000 if that's what their valuer confirms, and they'll lend against that figure. You don't need to show that you've done anything to earn that extra £50,000 of increased capital uplift by way of, improvements to the property and so on, which some lenders do often like to see. No minimum income requirement. You can be up to the age of 79 when you apply for a mortgage with them. As with foundation home loans, they will take personal guarantees from the directors only, and as we've discussed, that can be incredibly beneficial for some companies. They're really, really great if there is an element of minor adverse in the background. So, for example, if you had a missed mortgage payment, a year and a half ago, but you can demonstrate you had the money to pay the mortgage in a different bank account, you simply hadn't, transferred it across, and it was an administrative error. Rather than the fact you simply didn't have the means to pay the mortgage. They can consider these actually on a case-by-case basis. We just have to put together a compelling argument, a good justification for it. So like I say, a really, really solid offering from Kent Reliance, and another lender who has brought their pricing down to what I can really honestly only recall as the kind of their lowest pricing that I've ever seen. Now, having just gone through lots of rate changes and criteria changes from the more specialist lenders, we've also seen 3 of the more high street institutions reduce their buy-to-let pricing as well. And I think, again, this is really just testament to the fact that the lenders are really looking to drive up business volumes now. The kind of flurry of applications on the back of the stamp duty holiday has started to settle down. So we've seen rate reductions from BM Solutions on their purchase products. Their rates are now starting from an incredible 1.31%. Barclays have reduced some of their buy-to-let rates, and their rates now start from 1.8%. And the Coventry have made reductions on their products as well for both their standard and portfolio products, and these have been reduced by 10 basis points, and their pricing now starts from 1.45%. Now, all of these lenders are very much looking to lend to individuals, not limited companies. 2 of the 3 of them can lend where there are up to 10 properties in the background. The criteria is largely very similar. So BM Solutions and the Coventry, there's no minimum income requirement. They're looking for the more standard types of properties. Barclays, as we mentioned in previous weeks, just have the most complicated criteria in terms of exposure. Everything's done on an affordability basis. So we throw into the mixing pot with Barclays when we apply all of your personal income and your buy-to-let rental income and indebtedness, and there's a calculation that goes on, and out pops a number as to whether the mortgage is affordable or not. And I just find that a very, very untransparent way of doing things. I'm not the hugest fan. Having said that, it works really well if we've got, for example, a first-time landlord who's got a really well-paid day job and is fairly unindebted, then actually it can work really well for them. But as a mortgage brokerage who specialise in dealing with buy-to-let landlords, that doesn't tend to be the kinds of clients we come across frequently, and therefore these Barclays offering doesn't tend to work for most of our clients. Having said that, we have got some clients who it works for perfectly well also. But like I say, I think the key message here is that there is a definite trend at the moment in terms of downward pricing. Some of the rates that we're seeing, I just can't remember ever seeing pricing this low. And I suspect really the message here is that, there has been a bit of a rush to the bottom. The lenders are only going to go so far with their pricing. You can sit and wait it out and play chicken if you want to with the pricing and just see if you can get it to come down even further. But the reality is that with pricing from things like 1.31%, there's only so much further the lenders may be willing to go, and I can guarantee it's not much further. So if you are thinking about remortgaging or buying a property, in terms of the cost of borrowing, now is a phenomenal time to be taking a mortgage. Don't sit on your hands, don't delay. The pricing is what it is for the time being. Their expectation is that pricing will start to increase probably later on in the year, so now's a great time to get in there and secure yourself an absolutely incredible rate. House prices now. So house prices could hold on to the gains made during the market boom this spring. This is according to results of the Royal Institution of Chartered Surveyors June survey of members. So the report tells us that a net balance of 83% of surveyors reported an increase in residential prices in June, reaching a new high from 82% in May. Sales per surveyor rose to 23.6 in June, up from 22.9% in May. The price increase was supported by stronger demand compared to supply. The balance of surveyors reporting new sales instructions went deeper into negative territory in June at -34 compared to -24 in May. So essentially what we're saying here is that there are less properties coming onto the market. And yet, meanwhile, buyer demand cooled but remained comfortably positive at a net balance of 14 for June, down from 29 in May. So what we're seeing here is that the number of properties coming onto the market is reducing even further. And while the demand for property has cooled off slightly, actually it's still very much in positive territory. And these two things combined, i.e. it's the normal story, demand outstripping supply, is where the surveyors are feeling very comfortable that house prices will remain or be sustained going forwards. They went on to say that a net balance of 56% of surveyors expected prices to increase in the next 12 months. And market experts suggested the figures showed that the current pricing would certainly hold up. So I think there's a really, a positive message for those people who have acquired property most recently, but also for those people who are thinking about investing going forwards over the coming 12 months, have been waiting to see what's going to happen with house prices. Again, and this is a theme that we're seeing week on week. The expectation is they're going to hold firm and actually increase over the coming year. Nationwide have also shared some insights with regards to the housing market, which I thought I would just briefly touch on with you. So first of all, the house price index shows that annual house price growth accelerated to above 13% in June. So regional data for the 3 months of June indicates that all parts of the UK saw an acceleration in annual house price growth. Northern Ireland and Wales saw the largest gains at 14% and 13.4% respectively in quarter two. By contrast, Scotland saw the weakest rate of annual growth at 7.1%, followed closely by London at 7.3%. Interesting, isn't it? We're talking about weak growth at 7.1%, whereas ordinarily would be like, crikey, that's really, really strong. Now, in terms of what people are looking for, the report talks about the race for space, and what they're essentially saying here is that there really is a trend in terms of people's sentiments for moving house. So they say that it comes as no surprise that the pandemic has made the nation think more deeply around their living arrangements. So of those moving or considering a move, around a third are looking to move to a different area, while nearly 30% are doing so to access a garden or outdoor space more easily. And I think in terms of if you're looking to invest in a new buy-to-let property over the coming months, I do think that's really worth keeping in mind if you're looking for really strong rental demand for your property, that actually if people are looking to buy houses with outdoor or properties with outdoor spaces or access to outdoor space, actually it makes perfect sense that the same kind of thought process would be in place for people when they're looking at their rental arrangements also. The Building Safety Bill was published on the 5th of July, and it's one which is apparently going to create lasting generational change and set out a clear pathway for the future on how residential buildings should be constructed and maintained. Now, there are some key measures in the Building Safety Bill which I just wanted to share with you, and there's one in particular which I think is really, really relevant for you guys to understand about. So first of all, the first objective is to ensure that there are clearly identified people responsible for safety during the design, build and occupation of a high-rise residential building. Another one is to establish a building safety regulator to hold account those who break the rules and are not properly managing building safety risks, including taking enforcement action where needed. To give residents in these buildings more routes to raise concerns about safety and mechanisms to ensure their concerns will be heard and taken seriously. Drive the culture change needed across the industry to enable the design and construction of high quality safe homes in the years to come. And this is the one that I think is really important. Extend rights to compensation for substandard workmanship and unacceptable defects. And this is all coming back to the cladding issue and the EWS one reporting reports that we're kind of causing some of our clients so many problems at the moment. So, under the proposals, the government is more than doubling the amount of time from 6 to 15 years that residents can seek compensation for substandard construction work. Now, these changes will apply retrospectively, which means that residents of a building or owners completed in 2010 will be able to bring proceedings against the developer until 2025. These reforms also include new measures which apply to those seeking compensation for shoddy refurbishments which will make the homes unlivable. So I think the key here is that actually the ability to gain recourse against potentially the developer for properties which are now classed as unsafe is really kind of at the fore here, and this could be really good news for our landlord clients who have properties where the property has failed the EWS1 checks. That is everything from us this week. Thank you so much for joining us. I hope you found that really helpful. If you do have any questions, you can give us a call, 0345 345 6788. Have a look at our website. There is an absolute abundance of information there for you to have a look at. Do look after yourselves. I'll be back again this time next week. Thank you for joining us and have a really fantastic weekend.